I'm pleased to welcome you all. Really thankful that at such a short notice you all have been able to join. Uh, I'm pleased to welcome you all to enable us this session so that we can know the details and the background of the new instruments and the auction calendar, particularly the floating rate PIBs, which are being introduced for the first time in these tenors. We decided this session only a few hours ago, and as you can see, the auction calendar being announced and just came today, while there is an auction tomorrow as well. So we thought people would get the benefit to know the details about the instrument directly from Ministry of Finance, and I'm really thankful to Mr. Abdul Warraich, DG DET, Ministry of Finance, for taking time out to share the details with us. He's always very open with regards to providing information to the market and talking to the market. So Warraich is obviously kind of being very kind, a regular speaker here. I believe he needs no introduction. So we'll just go directly to the DG DET office where Warraich and Mr. Zahid is also there. So before we just connect and I hand over the session to them, just a few housekeeping announcements. So there is a talk, first of all, by Mr. Warraich, and this will be followed by a session, Q&A session, for which I have requested our senior colleague, Mr. Asif Qureshi, who also needs no introduction, being a very senior member of the society and very senior in terms of the capital market presence. So audience would be able to ask questions through the chat box, which we would enable at the end of the session. And I am also, I think, thankful to my team, CFA Society Office, who has just been very quick to bring this session to you. Thank you, Sarwat, and the rest of the team members. Now I would request Mr. Warraich to take charge. This is your show, sir. Thank you.
Thank you very much, Mr. Asim and Mr. Asif Ali Qureshi and Ms. Sarwat and all the team of the CFA Society. We are really grateful that you arranged this session on a very short notice, and we are extremely grateful to all the participants for making time for this session on a short notice. So I would just get to the point. I will give you a background of the recent changes in the borrowing plan, which is now evident in the latest auction calendar that all of you must have seen already. By the end of the last financial year, before the IMF program began, the domestic debt of Pakistan, its profile had become very skewed. A very large proportion of domestic debt was held by the central bank, and the portion which was held by the market, most of it was in the form of short-term securities, that is treasury bills. And practically all of the debts held by the central bank was also in the form of short-term treasury bills. So the challenge was to have a strategy and to extend the maturity profile of the domestic debt, because the government was coming under a lot of criticism because of the very short-term nature of the domestic debt. And the auction pattern had also become very erratic. Some of the auctions were very large. In certain auctions, there were hardly any bids. So the cash management was also becoming very challenging for the Ministry of Finance. So when we went into the IMF program, we thoroughly discussed the situation with the central bank and with IMF, both of which have been advising us and working closely with us. Until at the beginning of this year, the forecasts or the projections for the fiscal deficit were also quite high. And our focus was mainly on the incremental borrowing, the additional borrowing that we had to make for financing of the fiscal deficit. And our strategy has been to meet most of the incremental borrowing needs through long-term securities. You must have noticed that after many years, there was a regular and steady issuance of long-term bonds, both fixed rate and floating rate. Fortunately, we had a floating rate instrument also, which was already introduced before this financial year began. So we decided to use a mix of fixed and floating rate bonds to meet most of the domestic borrowing needs during the year. And our preference was to not to let the stock of treasury bills increase in a big way. So far, we feel we have been to a great extent successful in that strategy. Most of the domestic borrowing during the year has come from government securities and the long-term ones. Very little has been borrowed through treasury bills. Uh, but still, there was a constant feeling that the treasury bill stock already is too high in the first place. So the other objective has been to devise a strategy to reduce the treasury bill stock to some extent so that the domestic debt portfolio becomes more balanced. And of course, the benefit would be that the maturity profile would be lengthened even more, uh, and uh, the short-term bias within the domestic debt portfolio needed to be addressed. So lately, we have been weighing different options, and we felt that now is the right time. Uh, Now that the interest rates have normalized to a great extent, we feel that right now the interest rates are neither too low nor too high. And this is probably the right time to start issuing more fixed rate bonds and also to convert at least a portion of the T-bill stock into longer term instruments. So we felt that the floating rate bonds are like a natural substitute to treasury bills because they have very similar durations and interest rate exposures. And the SLR eligibility criteria is also very similar. The floating rate PIBs are fully eligible for SLR purposes also. And since banks are the dominant investors in our market, and to a certain extent, mutual funds are also emerging as important investor class, we felt that both of these investor classes, banks and mutual funds, have a strong preference for floating rate instruments. Mainly because, of course, their liabilities are of a floating nature. Mutual funds want to avoid or minimize mark-to-market losses, and banks know that most of the deposits they have are short-term in nature, so they also have a strong preference for floaters. So we felt that floaters are a natural substitute of T-bills. The growing market interest over the last few months in the 10-year floater also gave us some encouragement that the market also thinks on the same lines. But at the same time, we also wanted to give more opportunities and encouragement to the market to invest in fixed rate securities. So, and another approach or objective that we had in mind was to to enable the investors to switch more easily between treasury bills and longer term securities. So until now, although we had been issuing floating rate bonds along with the fixed rate ones in the bond auctions, which were held once a month, but we felt that that needs to change if we want a more smooth transition from T-bills to floating rate bonds. So we decided to synchronize the auctions of floating rate bonds with those of treasury bills. So we decided to issue the floaters also in the fortnightly auctions, which are currently used only to issue treasury bills. So the idea was that when your treasury bills are maturing, the investor will have a choice to roll over the maturing amount in a treasury bill or to switch into a floater. And at the same time, we also decided to increase the fixed rate auction targets a little bit more to encourage and facilitate those investors who have preference for fixed rate securities. And we feel that it's a win-win situation for the government and the market. The government, as a result of this strategy, will be able to lengthen its maturity profile of its domestic debt, and the market will have more instruments to choose from, and there is an added incentive in the form of the extra yield that can be earned by investing in floating rate bonds instead of treasury bills, because these bonds pay a spread relative to the reference yield, which is a treasury bill. We wanted to start issuing floaters with quarterly coupons as well, because we wanted to have a long-term instrument which could serve as a substitute to treasury bills during times of rising interest rates also. So that product is also in the offing. We feel that we still need a few weeks to get it approved. Hopefully within a few months you will see floaters with quarterly coupons as well, which will be rather more perfect substitutes for the 3-month treasury bill. But right now we felt that the market demand is for the 6-month T-bills is greater, because interest rates are relatively stable and the risks to the economy and inflation are to the downside, at least over the short term, over the next few months. But we're working on the floaters with quarterly coupons also. Right now, the floaters that we have introduced will pay semi-annual coupons, just like the 10-year floater, which is already being issued for the last many months. And the yields will be linked with the 6-month T-bill yield, just like the 10-year floater. So these are essentially the replicas in terms of the product structure, replicas of the 10-year product that we already have. The only difference is that the maturities will now be, there will be now more options regarding the maturity of these instruments. You will be able to invest in the 3-year floater or the 5-year in addition to the 10-year one. So we have decided to synchronize the T-bill and floating rate bond auctions. We think this will provide more flexibility to the market players. You can switch in and out of T-bills and the floating rate bonds as per your preferences. You won't have to generate special liquidity to invest in floating rate bonds, which are currently being issued in a separate auction. So we think that this new auction strategy will bring some more efficiency in that sense also. One concern that all of you might have, in our opinion, is the expected liquidity of of the new floating rate bonds. But I would like to draw your attention to the auction calendar. You must have noticed that now there is going to be a very steady and regular issuance of floaters in all maturities. So we can assure you that we are doing all we can to make the floaters as liquid as the treasury bills. We want these to be very close substitutes. The only difference should be the remaining maturity, but we want the floaters to be highly liquid, tradable instruments. Um, and if there are any other regulations which need to be changed, we will work closely with the central bank and request them to modify those regulations, which may right now be seen as kind of a stumbling block towards making the floaters more liquid instruments. And similarly, if the mutual fund industry thinks that there are some regulatory actions, that some permissions or changes in rules which are required to make these floaters more desirable and easily investable for different types of mutual funds, we would like to work closely with you and convince the SECP to make those changes in the regulations. So the strategy broadly is to continue to meet most or all of the domestic borrowing needs by issuing long-term securities with a mix of fixed and floating rate instruments, and to also reduce the T-bill stock to some extent. So we feel that the market conditions right now, with interest rates being seen as kind of stable in the near future, um, and the risks to inflation are skewed somewhat to the downside, we feel that this is the right opportunity to enable the market to diversify their investments and to lengthen the maturity profile of our own debt portfolio. So that was broadly the strategy. We continue to borrow mostly in long term. We will stay close to the auction targets. We want to reduce the T-bill stock somewhat, and we want the floaters to be seen as close substitutes to T-bills. We are enhancing the fixed rate target so that those of you who feel that they have a preference for fixed rate should be able to invest there also. And as a result, although we understand that our borrowing cost will increase somewhat because we will have to pay some spread in case of additional spread in case of floaters, but we think that this additional cost is compensated by the lengthening of the maturities that we will achieve as a result. So that was broadly the strategy, the objectives that we had in mind, the background. I think at the beginning of this year, the portion of government securities that was held by the market, not by the central bank, 60% of it consisted of treasury bills, and only 40% consisted of PIBs. Although the PIB portion has increased substantially over the last 10 or 11 months, but the T-bill stock in absolute terms was more or less is still the same. And although this proportion has improved, I think right now the proportion is maybe 50-50, 50% T-bills and 50% bonds, but we would now want to see a more quicker transition with the treasury bills declining somewhat as a proportion of total government securities, and the longer term securities become a large proportion of the government securities portfolio. So I will end here and over to Mr. Asim and Mr. Asif Ali Qureshi Thank you once again. Thanks very much for making time for this session and for this engagement. And I would like you to share your concerns and your feedback and whatever questions you may have. So let's take advantage of this session and discuss some new ideas or concerns that you may have and try to address them. Thank you very much.
Awesome. Would you like to add something here?
Sir, I think you go ahead so that we can come straight towards the Q&A, because the idea is that we interact with the market. So I would hand it over to you. So kindly initiate the question and answer session as announced earlier. So audience can ask questions through the chat box, and I would request Asif Qureshi to kindly manage the Q&A session. Thank you.
Thank you. Thank you, Asim, very much for entrusting me with the responsibility of conducting this Q&A session. It's always a pleasure listening to Mr. Warraich speak, although he's answered a lot of questions that I had initially thought about once this session was announced. But nevertheless, I'll give it a short while we start receiving some questions from the audience. Firstly, I just want to understand, and maybe the audience would like to know as well, we understand the reason why you want to extend the maturity profile, and a lot of these instruments you've talked about for a considerable amount of time. But why this sudden rush to the issuance of these instruments on a day's notice? Generally, whenever these new instruments are introduced or any auction is announced, you allow a period of 2 weeks for the when issue trading to actually take place, but it's not happening in this case. So I'll appreciate your thoughts on that.
Yeah, all right. Actually, we have been thinking and deliberating this change in strategy for quite a few weeks now. But of course, there were many stakeholders that we were consulting. And finally, once we came close to a final decision and a strategy, we felt that we should not wait for the next financial year, and we should now straight away launch the new strategy. We have a significant quantity of treasury bills maturing in tomorrow's auction. There is a decent portion which is held by the central bank also, that is also maturing. So we felt that we have been thinking for quite a while now, and now that the plan is in place, why wait for another few weeks and go for it? But we understand that it may have made the market nervous, a little bit nervous. And that is one reason why we requested you for this quick engagement, so that we try and address as many concerns as possible. But I think your concern is legitimate. It could have been done more gradually. It's just that we felt that the timing was right, and now we should get going with the new strategy.
Thank you very much for that answer. Just another question from my side, and that's you've already brought about certain changes to the way the NSS rates are redetermined after each PIB auction. Can you just throw some light whether you are planning any further reforms in NSS to sort of complement the changes that you're bringing about in the debt market?
Yes, there was a criticism, an ongoing criticism as to why certain institutions are allowed to invest in the saving schemes. And the argument was that institutions have the expertise and the resources to hire the expertise if they don't have it on their own. And the institutions should be participating in the public auctions. They should be competing with other participants. And any retail schemes, these saving schemes should be basically meant for retail investors who have little understanding or expertise to participate in competitive auctions. So that was an ongoing criticism, and I would like to tell you that we have already initiated a proposal which is backed by the central bank and the SECP also, and is supported by some of the international partners such as World Bank and Asian Development Bank also. So we have proposed to the government not to allow any institution to invest directly in savings instruments. So we are optimistic that the proposal will go through. Actually, all institutions were banned from savings instruments back in 2001 or 2002. But for some reason, certain institutions, mainly the employee funds, the retirement funds, the pensions and providents, they were allowed to start investing in saving schemes, I think back in 2008. But now we are making all out efforts to change that once again. We want all institutions to start participating in the auction markets so that these the primary as well as the secondary markets become more liquid, more competitive. So we are hoping that yes, this change in policy will go through, and hopefully within a short period of time, you will find that now all institutions which want to invest in government's debt must participate in public auctions. And that is very important to make these auctions successful also, because now the retirement funds have become very huge. They have become important players in the capital markets, and we want them to be competing for the longer term instruments in the auction market. So it is very important for the success of the instruments and the new borrowing plan that we have introduced.
Thank you very much. We received one question from the audience, and a lot of questions actually. The first question that I want to ask is, by how much will you be able to extend the maturity profile of debt by issuance of these 3 and 5 year floaters? And if for some reason you don't see healthy participation, would you be able to, what would be your fallback plan in that situation?
I would like to tell you that right now, the average maturity of domestic government securities portfolio is around 4 years. But since there is a huge T-bill stock outstanding, so we would ideally want to, in the first go, we have set a target of 5 years average maturity. We don't know whether we'll be able to achieve it in 1 year or 2 years, but we are confident that this is on the cards now. Now that we have decided to meet most of the domestic borrowing needs through longer term securities, and we are prepared to pay a somewhat higher cost also in terms of additional spreads. So we are confident that we will move quickly in that direction. As for the question that if the market doesn't participate in a very big way in the new instruments that we are offering, I would only say that we are determined to make these instruments successful, and we will continue to seek your feedback if you think that these new securities in any way do not meet your investment preferences in terms of returns or maturities or risk exposures. We would very much like to review the product structures, but we are determined to lengthen the maturity profile, to make the new product successful. We are ready and willing to change any features, to introduce any new features if that is necessary to make these products successful. So, so to begin with, I would say that we are kind of determined right now, and we will do whatever it takes to to make these instruments successful, because it is important for the debt management strategy of the country.
Okay, thank you very much. Another question from the audience. Is there any plan to gradually sell the long-term floater stock which is lying on the State Bank balance sheet, or you will be issuing only new issues through the auctions?
Actually, the floater held by the central bank is the 10-year instrument. So right now we feel good that we won't have to retire those instruments anytime soon, because the government is already faced with huge borrowing requirements. Our budget deficits are still a bit too high. We are hoping that the budget deficits will come down significantly over the next few years as the fiscal consolidation takes hold. And we are already retiring close to 600 billion to the central bank every year. We have already retired close to 285 billion worth of treasury bills back in December 2019. Another 285 is supposed to be retired a few days from now. So that will bring it to 570 billion for the year. In the next year, I think two fixed rate PIBs amounting to 570 billion are maturing, and we plan to retire those. So there are significant maturities over the next 2 years in the range of 600 billion per annum. And after that, I think the maturities of the central bank debt will go down to an extent. I think 2 years from now we'll be retiring 300 billion per year for 2 more years. But as for the floaters maturity, right now we have no intentions to change that. But once the fiscal position of the government improves, and we feel that our incremental borrowing requirements have come down, and now we are ready to maybe swap those securities with new ones to be issued in the market. Maybe 2 years down the road, we will think about that. But right now, any plan of that sort is not on the cards.
Okay, thank you very much. Another question about tomorrow's auction. The coupons are yet to be decided, so a lot of people are interested in knowing which T-bill yield will actually be used for benchmarking or for setting the coupon for tomorrow's auction. Is that going to be tomorrow's T-bill yield?
Yes, it should be tomorrow's T-bill yield. We can seek a clarification from the State Bank also. The rules say the most recent T-bill yield. So the most recent, by all means, will be tomorrow's, because it is tomorrow's auction is taking place simultaneously. And the relevant T-bill, of course, will be the 6-month instrument, because these instruments will pay semi-annual coupons, just like the 10-year floater. So yes, our understanding is that it will be tomorrow's T-bill yield, but I will discuss it with the central bank, and I will request them to issue a clarification also, preferably today, to the market, so that there is no ambiguity on this account.
Okay, thank you very much. Another question is a concern that sometimes the 6 months T-bill auction target is not met, and perhaps the 6 months bill yield is actually depressed abnormally. So benchmarking off that yield makes the investors in floater, in a less favorable position. So the gentleman is actually suggesting whether it would be viable for the government to actually consider benchmarking it off 6 months PKROE.
I think we already have a rule. I think we've already a rule in place which says that if the cutoff is not announced, if for any reason the 6-month T-bill is not issued, then we will take the average of the last 5 PKRVs. We feel that the current rule is, is pretty balanced, but if many of the participants feel that even the current rule is not good enough, because initially it was supposed to be the 6-month T-bill yield. There had to be a cutoff. And you're right, at times when the auction was scrapped, there was a lot of confusion as to whether uh, how to determine the reference yield. But now that problem has been overcome. But if many of you feel over time, let's try a few auctions. If many of you feel that this is not the best way to benchmark the floaters coupon, we can think about new options. We already have an average of 5 PKRVs. We already have that rule in place, but it is triggered only when there is no cutoff. But I think with the situation normalizing, we believe that now there should be a decent demand for 6-month treasury bills. In recent auctions, we have seen much more interest in the 6-month instruments. So we don't think it's an immediate issue, but we are ready and willing to consider the alternatives if many of the market participants feel that the purpose is not being served with the existing rule.
Okay. Then there's a couple of people asking whether these new floating bonds will be reopened in subsequent auctions, or there will be an issuance of new. Okay. And for how long will you keep reopening them?
I think I posed this question to you guys also in one of our earlier engagements as to what is an optimal size for a single bond issue. We personally feel it ranges from 1 to 2% of GDP. So our preference would be to have each issue size range between 1 to 2% of GDP, which currently would mean anywhere between 400 and 800 billion worth of issue size. And definitely the bonds will be reopened just like the 10-year floater is reopened. So the 3 and 5-year floaters will also be reopened in the same way. And our target is to have issue sizes in the range of 1 to 2% of GDP. But this, of course, is, a debatable issue. We will keep getting feedback from you. If you think that this is not a good range for an optimal issue size, we can have different targets. We can increase or decrease depending upon your feedback.
Okay, thank you very much. And there's another question about the Ijara Sukuk auctions, whether you intend to stick with that 450 billion planned, or there is going to be change in the amount of the amount that you will be raising through the Ijara Sukuk.
Actually, to be honest, internally we are planning to issue more. We are planning to issue almost double this amount over the next financial year. But the problem is that right now we have only one Ijara issue in hand. And I think during the next financial year, the amount that we can potentially issue, assuming that this is all we have, the potential issue size would be between 450 to 500. But we are working on introducing new issues. I received a few telephone calls from a few Islamic banks today, and they had the same question. They thought that the amount should be higher. So we are already making a plan for bringing new Ijara issues to the market. Hopefully, I cannot, guarantee that right now, but hopefully the actual issuance would be well above this number that is currently mentioned in the budget. That's our target.
Okay, thank you very much. Other question, whether you plan to issue any inflation-linked securities?
Yes, although we believe that the floaters very much follow the inflation linking principle, but still we feel that having uh, an explicit inflation linked set of securities would help in many ways. It would fulfill the needs of many investors which are very inflation conscious, like pension, whose liabilities in particular are inflation linked. Um, and on the other side, it will put pressure on the government to discipline itself more because some of its liabilities would be explicitly inflation linked. So that is definitely something that we are already considering. And let's set a target to introduce uh, at least one or two inflation indexed securities over the next financial year. So I assure you that we will set an internal target that we should be introducing at least one or two inflation index securities during the ongoing financial year. That was definitely in our minds. Uh, but it's good that the market is also realizing and nudging us towards issuing such securities. Um, so I can tell you that we will definitely work on these lines, and we will try to bring at least one or two inflation-linked securities very soon.
Okay, thank you very much. Slight digression from the main topic for today's talk, but we've received a couple of questions regarding one or two issues relating to the budget with respect to the domestic debt servicing costs. That shows an increase of about 11% over the revised estimate for 2020 fiscal year, despite the fact that interest rates have come down quite dramatically over the course of the last 6 months. In fact, over the last 3 or 4 months. So there is some confusion as to whether these numbers have been overestimated just to keep some sort of a cushion there. What are your thoughts?
No, I can assure you that there is no cushion in these estimates. I will tell you the reason why is it so. And we understand that the market was expecting a decrease in the interest servicing cost, and the increase in the budgetary estimates have come as a big surprise to the market. I actually had a discussion on this with Mr. Asim the other day, and I would like to tell you two or three main reasons behind that. When the current financial year started, we had a huge stock of treasury bills, and almost all of these treasury bills were the 3-month tenor. So now that the government is following a cash accounting system, the interest on a treasury bill is paid on maturity. So if we had continued to roll over this amount in 3-month treasury bills, I think the opening stock held by the market was in the range of 5 trillion. And our borrowing cost on average has been between 12 and 13% per annum. So the interest expense on treasury bills only, assuming that we issue no new treasury bills, just rolling over the existing stock, should have been in the range of 600 to 650 billion. But the actual interest expenditure was almost 200 billion less than this amount. And the reason was that during the year, as the market situation stabilized and the market started to expect a decline in interest rates, we started to receive fewer bids in the 3-month tenor and much higher bids in the 6 and 12-month tenors. I think out of the 5 trillion worth of T-bills outstanding at the beginning of the year, almost 4 trillion was converted into 12-month treasury bills during the course of the year. So this 4 trillion is now going to mature in the next financial year. And going by the cash accounting system that we follow, the interest expenditure on these instruments also shifted to the next financial year. So this was just the T-bills part. And then there was a slight anomaly in case of bonds also. You know that we typically replace the bond issues in August and September. So we did the same during the current financial year. We introduced new 3, 5, and 10-year bonds and a 10-year floater also in August and September of 2019. And we issued a huge amount in these bonds. I think between 2.5 to 3 trillion already has been issued. But since these bonds pay semi-annual coupons, we did not pay 2 coupons in the financial year because the bond issues were introduced in August and September. So we paid only 1 semi-annual coupon in February and March. The second coupon would not fall in the current financial year. So in case of bonds also, the actual interest payment that we made was only for 6 months. And that also served to lower the interest expenditure in the current financial year. If we were following an accrual accounting system, our interest expenditure in the current year would be higher by at least 300 to 400 billion. And the next financial year's interest expense would be lower by that. But I can tell you that as a result of the policy rate reduction, we estimate that we are going to pay 4 to 450 billion less in the next year. If the policy rate was not reduced by this much, our actual interest expenditure would be higher still by another 4 to 500 billion. So I think that will answer the question that most of you have in mind as to why interest expense is increasing when the policy rate has declined. It's mainly because of the way the debt portfolio evolved during the current year, combined with the cash accounting system that we follow, in which we record interest expenditure only at the time of payment.
Well, thank you very much for that clarification. Another question from the audience: is there a target mix in mind that you have, sort of targeting between T-bills, floating rate PIBs, and fixed rate PIBs?
I would say right now 1/3 of our government securities is T-bills, and 2/3 is bonds, mostly floaters. I'm including the central bank debt also, the overall portfolio. We would want to see a T-bill stock in the range of maybe 20 to 25% of the total government securities. Fixed rate in the range of maybe 35 to 40%. And the remaining 30 to 35% through floaters. Actually, we would want the proportion of fixed rate debt to be even higher. But considering that our market is dominated by the banking sector, which has a higher preference for floaters because their liabilities are floating. So we're hoping that over time, the genuinely long-term investors will also grow in size. Companies like the pensions and the pension funds and insurance companies and the voluntary pension schemes managed by the mutual fund industry. So we are hoping that as the non-banking financial institutions grow in size, this mix can change more, because ideally we would want the fixed rate portion to be even higher. But right now, with the existing market realities, this is what we are targeting.
Okay, thank you very much. One question again, coming back to the budget. Can you update us on the progress that has been made with respect to the Treasury single account? And is there any reflection of the TSA being implemented anytime in the next fiscal year in the way you've estimated your debt requirements?
I think it is one of the important targets that the government has set for itself in agreement with the IMF. But to be honest, the progress on TSA has been slow so far. Because in the current year, partly because of the economic slowdown induced by the pandemic, uh, we feel that the budget wing has been more focused on short-term flows and developments. On the budgetary side, they have not really been able to focus on the long-term initiatives such as the TSA. Um, all I can tell you is that we expect more progress, a quicker progress to be made on this side. But our understanding, the debt office's understanding, is that there is a very large number of accounts running into tens of thousands held by various government entities with the commercial banks. And it's not going to be an easy exercise to determine which of these accounts need to be made a part of the TSA. So I don't see it happening very soon. But I think the issue is important, and as things improve, the Ministry of Finance will definitely dedicate more resources to sorting out this issue. I cannot give you any timelines. All I can tell you is that definitely there will be more progress on this front. But right now, the challenge of sorting through tens of thousands of accounts is a pretty huge one, and it will definitely take quite a few months before the government is ready to announce uh, which and how much of these so-called commercial bank balances are going to be consolidated into TSA. So I don't see too much progress happening too quickly on that front. That's all I would say at this stage.
Okay, a couple of questions if I could ask about the external financing part of the government's plan. Can you give us some sense as to when the government plans to go back to the international markets for Eurobond issuance? Now that the rates have actually come down, initially post-COVID, the yields have had spiked, but over the last couple of weeks, they have come down fairly significantly.
I totally agree, and I acknowledge it was a big mistake or lapse on our part that we were unable to issue Eurobonds during the current ongoing financial year. We should have done it back in November, December. The market conditions were very, very promising. And you're right, now after a spike in the yields, now the markets are becoming more stable and calm, and the yields are again coming down. Uh, and that is one reason we have budgeted 1.5 billion US dollars in the current budget. You must have seen the number. It should be close to 250 billion. So we are targeting a gross issuance of $1.5 billion this year. But last year we were also faced with certain legal challenges regarding the issuance of Eurobonds. So we are hoping that those legal issues would be resolved in the near future. And that is why we have targeted an issuance of 1.5 billion US. So I cannot say for sure that it will happen, but we are keeping our fingers crossed. We are all set to go for at least this much of issuance during the next financial.
One final question before we wrap this up, this Q&A part of it, about the maturity profile of your of the government's external debt. Can you throw some light on how much, what sort of maturity profile do you have on external, on the part of the government's external debt? And do you think that there can be any changes made to that profile to make it more favorable for the government?
I would request Umar Zahid, he's my colleague. He's the director in the debt policy office to respond to that question. He is kind of our expert on the external side. He knows more than I do. So I would request him to answer this question.
Good evening, everyone. I just need to reply with respect to external financing. We basically have a maturity of around 9.5 billion US dollar. And we have also applied for the debt relief from the bilateral countries. That's amount to around $2 billion. So in the nutshell, we will have the maturity of around $7.5 billion in the fiscal year FY21. But this maturity also consists of a huge amount of maturing commercial loans, mostly from the Chinese banks. So all in all, government has, if you include the Chinese maturities, that is more than $3 billion, we will left with a maturity of around $4.5 billion, which the government is going to refinance or get new loans to refinance the existing maturities. So
the average maturity is 7 years for the external?
For our external debt portfolio, average maturity is 7 years, and we intend to maintain it or increase it over a period of medium term. Over the period of medium term. So I would also request all the market participants that the government has uploaded the medium term debt management strategy on the Finance Domain website. So you can also refer that contain a lot of detail. I have seen many questions which we have already answered in the MTDS, which we have recently published, like introduction of zero coupon bond, introduction of inflation-linked securities, and many other questions have already been answered in the MTDS, which is available on the public domain now. Yeah.
7 years the minimum.
So we have also set some target for the debt portfolio. Like we set some target for gross financing requirement. We set some target for the average maturities. We set some target for the scoop issuance. And we have also set some target for the fixed rate component of our government debt securities portfolio. So all these targets are mentioned there, which the government plans to achieve over the medium term.
I would request you to urge the participants to get familiar with the medium-term strategy. In the past, the general perception has been that the government doesn't really follow its medium-term strategy. But right now, we can assure you that we are serious in following it and in meeting the targets that we are setting. So we would urge you to please take a look at the medium-term strategy. Maybe we can have a special session dedicated to discussion on that strategy.
Thirdly, I think a discussion or a session on the medium-term strategy is going to be very useful and informative for the audience. With that, I think we can wrap up the Q&A session. And thank you very much, Warraich and Umar Saab, again for answering all the questions with a lot of patience and with a lot of detail. And as always, it's a pleasure listening to both of you gentlemen. And I would like to, hand the mic back to Asim now.
Asif Saab, I think it's a very valuable session. I would like to thank Mr. Abdul Rehman, Warraich, Mr. Zahid, and Asif Qureshi for making this session very meaningful. And thank you to all the audience who have just joined at, I think, 1 hour notice or 2 hours notice. We had a very good reach in terms of creating this session to the market. So thank you very much all. I hope such sessions will continue in the future. Thank you very much.
Thanks very much to CFS Society, to Mr. Asim, Mr. Asif Ali Qureshi, Ms. Sarwat in particular, and all the participants. We are really grateful for your time and attention. Thank you very much.
So Asim Saab, I just need to answer one question. Yes, we are doing BAM module transaction against our maturing sukuk. So one question was here that whether we are going to having BAM module transaction. Yes, we are doing it this month.
Yeah, it will be a 3-year BAM module, just like before. So it's going to happen this month. Yeah.
Before this year end. Okay.
Yes, yes. All right. Thank you very much.
Thank you, sir. Thank you very much.
Thank you so much.